Hello, good morning, everyone. Welcome to our this week's research morning call. Today we have quite a few stock counter updates, as well as our usual technical analysis and Singapore Weekly. Without further ado, I invite my colleague John to share about NVIDIA.
Thanks, Helena, and good morning, everyone. So, like Helena mentioned, I'll just begin with NVIDIA's fourth quarter 2024 results. We issued a report last week titled More Upside from AI Demand. So essentially for NVIDIA, it's still all about AI demand. If you look at their results, it exceeded expectations, even beating its own guidance on revenue by about 11%. In terms of fiscal year 2024 results, its revenue and PATMI came in at 103% and 108% of our forecast. So when it comes to AI demand, you can still see and not just from NVIDIA but AMD as well, and a lot of commentary from other semiconductors is that AI demand is still very exceptional, and it's driving a lot of outperformance for a lot of these companies. Most of this demand is actually coming from not only internet companies like Meta and Google, but also coming from cloud service providers like Amazon, as well as sovereign nations which are beginning to leverage on AI and to build out their own AI infrastructure. And so what we also saw is that gross margins were a kind of a beat. They were 150 basis points beat. So gross margins came in at 76%, which is significantly higher than historical gross margins, mainly because of this shift to higher margin data center products. When you look at historically, NVIDIA's gross margins have always been around 60%, so this is quite a significant increase, and has been increasing quarter on quarter for the last 6 quarters. Forward guidance was also very strong. It implies more than 3 times growth for this upcoming first quarter, mainly because the main problem for NVIDIA is that it has demand that far exceeds supply, which is a good problem. So you see, it's really constrained by how many GPUs it can supply to its customers. And so NVIDIA has also been working through its supply chain to improve and increase supply so that it first of all can fulfill its orders, and secondly can generate more revenues moving forward. The big knock on NVIDIA is still China. China still remains a question mark because of the US export restrictions. So just a bit of backstory: the US essentially banned or temporarily banned a lot of exports to China from US manufacturers of high spec tech items. So not just semiconductors but other items as well. They essentially required these companies to get licenses from the US government to export these to China. Although obtaining a license seemingly is almost impossible, and it's a long drawn process. So what NVIDIA actually did was it kind of re-engineered its H100 GPU to slightly lower spec products so that it kind of circumvents these restrictions and are able to export it freely to the US. The big question for this is that obviously it's not as in terms of specs, it's not as high performance as what the customers want. And secondly, it's very comparable to what the Chinese manufacturers are making right now. And so over the call, management was a little bit didn't seem too optimistic about competing in China in the long term because of these restrictions. Mainly because it's when it comes to China, they're able to kind of ramp up a lot of these, especially of the tech stuff, in relatively short periods of time. And once you lose market share there, it's very difficult to gain it back. In terms of how big this was to NVIDIA, you just take third quarter's revenue. China made up about 22% of NVIDIA's data center revenue. But in the fourth quarter, it made up only about 5%, so a significant drop there. And moving forward, it's still expected to remain in these mid-single digit range. So not much growth there. In terms of the outlook, first quarter 25, sorry, there's a typo here. Revenue guidance came in at $24 billion, which essentially is a 232% year-on-year growth rate. So slightly lower than its past quarters, but still, when you're growing 3 times year-on-year, it's very significant. And the data center revenue is expected to improve sequentially throughout this coming year. Like I mentioned earlier, mainly because as they have such a large backlog, as long as they continue to improve supply, you'll start to see kind of improvements in data center revenue sequentially. Um, we think that near-term growth expectations look quite sustainable given such high demand that is still out there, and especially as a lot of the demand is spreading to is stemming from other industries. When it comes to automotive, healthcare, financial services, and even like industrials. You're starting to see that it's not just a one-hit wonder, and demand should remain strong for quite at least in the near to midterm. Um, in terms of their product lineup for 2025, they plan to launch the H200, which is an upgrade of the H100, sometime in the second quarter. At the same time, they also have a new product, B100 and the Spectrum X. And all these products look really good, and not just that, but they are also at least 30% more expensive than their previous or their predecessors, and perform at a magnitude of 3 or 4 times more. So this should be a positive. It will help to boost NVIDIA's ASPs or average selling prices as well as margins, at least in the near term. So for our rating, we still maintain a buy, and we raise our DCF target price to $970, up from $685, mainly because we raised our 2025 revenue and PATMI estimates by 29% and 35% to reflect stronger demand and slightly higher margins. We expect NVIDIA to remain the key player and key beneficiaries from this global shift to accelerated computing. So we've been talking about a lot of your generative AI applications, as well as your large language models. And that's kind of why we're still quite bullish on NVIDIA, because demand still seems to be very robust and seems to have quite a long runway moving forward. So that's all for NVIDIA. I'll talk about the next counter, which is Phillip on the ground or for Grab Holdings. Next slide, please. Grab announced their earnings last week. We don't have any ratings on it, and the last closed at $3.16. In terms of their results, it was quite lukewarm. I mean, revenue was 30% year on year, which was pretty good, but revenue growth actually continued to decline sequentially from the previous quarters. We think a big reason for this is because as the company is trying to prioritize being profitable, they're cutting a lot of incentives. You can see here, incentives were down 3% year on year. And so it's quite clear that they are sacrificing a little bit of growth for profitability. They managed to issue their first quarter of positive net income, which was 11 million. So basically, break even. And moving forward, we do expect to see some improvements in this area, especially as they continue to use the incentives, for its businesses. In terms of the individual segments, deliveries, mobility, fairly standard. There's still quite strong growth. I mean, deliveries grew 20%, and mobility was up 26%, mainly because of increasing travel demand. So travelers are a big target for Grab. A lot of your back and fro to the airport is kind of where Grab is trying to capture a lot of the tourism. In terms of its financial services arm, which is I guess the newest business that they've had, they saw loans grow quite significantly to $1.5 billion, and they currently have about $374 million in customer deposits. So they actually, aside from their GXS Bank in Singapore, they also started their GX Bank in Malaysia. And unlike Singapore, there's no cap on deposits. So in the first couple of weeks, they had about 100,000 deposits. And I guess just from these numbers, about 300 plus million just coming from Malaysia itself. The big knock is that the costs actually increased quite significantly for their financial services arm, because a lot of these deposits are just sitting in the bank accounts, and Grab has to pay out interest payments to the customers, because in Malaysia they don't actually have any loan products or financial products launched yet. So the funds are just sitting there, and Grab's just paying money out, I guess free money in that sense. Obviously, this comes because they just started ramping there. But moving forward, they do expect some products to be launched and for loans to grow as well a little bit faster than what's been in the past. In terms of its outlook, revenue guidance was actually quite poor. 15% year on year signifies further deceleration in revenue growth. So that was the big knock. And adjusted EBITDA to be around 200 million, 190 million US dollars. If you actually work it back, they're still guiding for net loss for the full year because a lot of the adjustments, about 700 million to about 800 million, is all in their corporate costs. So it's like your building facilities and your headcount and stuff like that. And so they still expect to be not profitable on a I guess US GAAP basis, but it should continue to improve as they focus more and more on their cost structure. So overall, the key thing for Grab is improving profitability, but I think the key worry is that they're sacrificing a lot of growth. And for US investors, when you look at growth stock like Grab, when you look at 30%, 15% growth and decelerating revenue growth, it doesn't really bode well for the stock price, and kind of see that being very suppressed, at least for the last year or so, since they spec at $10. Yeah, so that's all for my Phillip on the ground. I'll hand it over to Ambridge for Airbnb.
Thank you, John, and good morning, everyone. So moving on to Airbnb's fourth quarter 2023 results. Next slide, please. So overall, the results met our expectations with full year 2023 revenue and adjusted PATMI coming in at 101 and 103% of our full year forecasts. So in terms of performance for the fourth quarter of 2023, the total revenue, it grew by about 17% year over year. And the main drivers for this was the 12% surge in its booking volumes and 3% surge in its average daily rental rates. And in terms of bottom line, the company reported 349 million GAAP net loss as compared to 319 million net profit in the fourth quarter of 2022. And the significant drop, it was mainly because of a one-off expense of about 1 billion, which was related to some income tax in the fourth quarter of 2023. And after excluding this one-off item, the company reported a adjusted PATMI of $489 million US dollars, and it was up like about 53%. And this was mainly driven by higher operating leverage and higher interest income. So in terms of positives for the fourth quarter of 2023, the booking volumes, they grew by about 12% year over year. And the main areas that it witnessed was the cross-booking trips. The booking volumes for cross-border trips, they increased by about 13% year over year. And the cross-border trips, they accounted for like 44% of the total bookings volumes. And also management highlighted that long-term stays of about 28 days or more, they remained resilient, and they like represented about 19% of the total bookings volumes. And this was mainly because of the flexibility of remote work environment. And this was a 1% increase as sequentially. So secondly, the company, it also reported the continuous increase in the supply on its platform. So the active listings, they grew by about 18% year over year to about 7.7 million. And this was mainly, we believe that mainly because of the continuous product enhancements, like it continuously added on new features like Airbnb rooms or monthly stays and the listings tab for the hosts. And also it continuously provides a marketing and support solutions to the hosts in order to provide or list their properties in a better way, and also to communicate with other hosts. And in terms of negatives for the fourth quarter, the company basically provided a weak outlook for the first quarter of 2024. So it expects its revenue to grow by about 13% year over year to about $2 billion. And this is like 4% drop sequentially. And the revenue drop, it's mainly because it expects the booking volumes to remain under pressure in 2024, mainly because of the tough comparisons. So in first quarter of 2022 or first quarter of 2023, the booking volumes, they significantly grew mainly because of the Omicron-led pent-up demand. And the average daily rental rates are expected to remain flat or to slightly up. And in terms of the margins for the full year of 2024, the management, it highlighted that the margins are expected to be about 35%, which is like a 200 basis point of drop as compared to the full year of 2023 of about 37%. And it said that this is mainly because it expects to maintain its margin base like of about 35%, and it plans to reinvest back into its business through like the R&D or something to like innovate its platforms further. In terms of valuations, we downgraded the stock from buy to neutral mainly because like the stock has run up quite significantly over the last few days. And we also reduced our target price from $157 to $150. And this was mainly because we lowered our full year forecast for revenue and adjusted PATMI by about 1% and 14%. And this was mainly because of the moderation in travel demand and also because of high operating expenses. So that's all for Airbnb. I would now like to pass it on to Glenn for UOB.
Thanks, Ambrish. Yeah, so for UOB, they released their fourth quarter and full year earnings. Their adjusted earnings of 1.5 billion for the fourth quarter was slightly above our estimates. And this was mainly due to higher fee income as well as other non-interest income, but offset by lower than expected net interest income and higher allowances. So their full year adjusted PATMI was at 102% of our forecast. So for the dividends, their fourth quarter dividends was up 13% year-on-year to 85 cents, and full year dividend did rise 26% year-on-year to $1.70, and the dividend payout ratio has been stable at 50%. For the positives, the first positive is that their fee income has continued to recover strongly. It grew 17% year-on-year, and largely due to higher credit card fees, which hit a new record of 125 million. So this was up 69% year-on-year, mainly boosted by higher card spending due to their city integration, which led to an enlarged regional franchise. Their wealth management fees also rose 21% year-on-year. Loan-related fees also grew about 5% year-on-year. For the second positive is that the other non-interest income surged 54% year-on-year as customer-related treasury income sustained momentum, while their trading and liquidity management activities continued to deliver good performance. For the third positive is that their new NPA formation fell by 2% year-on-year as the asset quality continued to stabilize during the quarter. The NPL ratio has also improved by 10 basis points year-on-year and quarter-on-quarter to 1.5%. For the negatives, the first negative is that their net interest income declined 6% from NIM, the net interest margin, falling 20 basis points year-on-year and 7 basis points quarter-on-quarter to 2.02%, mainly due to loan margin compression due to competition for high-quality credits, and as well as their loans remaining flat year-on-year. Second negative is that their credit costs had increased due to a lower GP write-back. So total allowances did rise by 17%, and this was because of a lower general allowance write-back of 9 million compared to a write-back of 18 million in the previous year. So their credit cost rose by 4 basis points to 25 basis points. The full year credit cost was also same at 25 basis points, but this came in within their expectations. So this was actually quite okay for them. For the last negative is that the expenses was up 4% year-on-year, excluding one-offs, mainly due to increases across the board, such as staff costs, revenue-related, as well as IT-related expense. But their cost-to-income ratio was relatively stable, and the full year CIR, or cost-to-income ratio, improved 1.8 percentage points to 41.5%. So they are guiding for a similar cost-to-income ratio going into FY24 of around 41 to 42%. Now, for the outlook, we do expect UOB's profits to continue to grow and into FY24 to grow by 8% on the back of stable margins, loan growth recovery, stronger fees, as well as stable provisions. And we also expect the credit cost to come in around their guidance of 25 basis points. They have guided for low growth of low single digit, as well as for the NIM to maintain at their exit NIM level of around 2% for FY24. And for fee income, they also are guiding it for it to be double-digit fee income growth, mainly due to recovery led by credit card fees, as well as fund management and wealth fees as the market sentiment recovers. So this double-digit fee income growth in FY24 could add around 220 million to their revenue. So for loans growth, they also are seeing for loans to pick back up, mainly because of the rate cuts, which are expected in the second half of FY24. And they are guiding for loans to grow around 1 to 3% in Singapore and 4 to 5% in the region. So they are guiding for a low single-digit loans growth for FY24. I think I saw a couple of questions, comparing, why UOB is the share price dipped also. And I think, so for us, we do maintain a buy for UOB, mainly due to the growth that will come from their stable NIMs, loan recovery, as well as double-digit fee income growth. And this will continue to grow their earnings, which I mentioned earlier. We are expecting 8% growth in FY24 earnings. But we do, so that we maintain a buy with a lower target price of $34.90. But on the flip side also, I think we do prefer DBS because of their higher dividend yield. So if you look at UOB's dividends, they did increase their dividends, but even with the increase in dividends, their dividend yield for FY23 was only around 6%. And if they are forecasting also a very stable dividend payout ratio of 50%. So if we forecast that out, our forecast is looking at around 6.7% dividend yield for FY24. But if you look at DBS, they are providing a much higher dividend. They have been a lot, I guess, a lot more open by saying that they will increase their dividends, and by how much every year. So their dividend yield is currently around 7.2%. So that's why we prefer DBS to UOB. So that's all I have for UOB. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, so first up, we have Prime US REIT. So Prime US REIT, the key highlights was basically that they have a refinancing that's upcoming, and based on the FY23 year-end valuations, there was no breach in their gearing level. So that's the immediate positive. Yeah, so other than that, for the full results, the FY23, the DPU was below our estimates because they only paid US 25 cents in the second half. So that's equivalent to about 10% of their second half distribution income. And they also, on top of that, they also paid a 1-for-10 bonus issue. So that is roughly equates to about 43% of distributable income. And based on the share price before the announcement, the value of that is about 1.03 cents, US cents. Yeah, so if we strip that out, the fact that they are not paying 100% payout ratio for FY23, if you strip that out, the DPU estimates, our DPU estimates would have been in line. Yeah, so basically the year-on-year drop in DI is mainly because of lower portfolio occupancy, higher finance costs, and the fact that they are paying 100% of their managers' base fees in cash versus 20% in FY22. Yeah, so for the positives for them, their leasing activity picked up in fourth quarter. So the amount of leases signed in the fourth quarter is more than the first 3 quarters of the year combined. And they also managed to re-sign the leases at 9.6% positive rental reversion. Another positive for them is that their portfolio occupancy improved quarter on quarter to 85.4%. But the thing is that as of 31st December, this 85.4% still accounted for Sodexo. So after 31st December, Sodexo, they vacated the asset, and that is a net loss of about 3.8% in occupancy. So right now, the occupancy has dropped to about 81.6% post the financial results. Yep, and so for the negatives for Prime, the portfolio valuation, it fell 8.7% year on year. And this drop in 8.7% is better than we anticipated. Yeah, so as a result, this gearing is still within the MAS leverage limits of 50% when the ICR is 2.5 times. So Prime's gearing is 48.4% and their ICR is above 2.5 times, which is 3.1 times. Yeah, so now they are having they have to delever because 48.4 is really close to the 50%. So another negative for them is that they have yet to refinance their loan under their main credit facility. So this is a $600 million loan, which is due in July 2024. So it accounts for about 68% of the total loans. So right now, their cost of debt is flat at about 4%, and with 79% of their debt hedged. And even though their main credit facility is $600 million, it expires in July 2024, they have some hedges in place that is hedged all the way through to 2026. So that is a plus also. The management seems confident that they will be able to refinance because they stated things like the LTV for um, US office commercial properties is usually 60 to 65%, but in Singapore, because of the gearing limits at 50% is more conservative here. So they are quite confident they will be able to refinance the loans. So for the outlook, they are targeting to lower their gearing. So they are targeting to execute about 100 million in US deal leveraging in 2024. So this could be a form of divestments, possibly. And Prime, they have not committed to any future distributions. And they will evaluate the situation dynamically as the time comes. And they halted their distributions, or rather not halted, they lowered their distributions to 10%, mainly because they are keeping it for capital capex needs and capital retention and for liquidity purposes. Yeah, and currently in place rents are still 6.5% below the asking rents, so there's still potential to have continued positive rental reversions. So this continues from the 9.6% in fourth quarter, and they also have no exposure to WeWork. So after the results, we lower our DDM, our target price, from 37 cents to 30 US cents. In our estimates, we also accounted for a 25% payout ratio in FY 2024. So that brings, after accounting for that 25% payout ratio, our dividend yield becomes 8%, our forward dividend yield 8%. And right now, Prime is trading at 0.22 times price to NAV. So we use 25% because in this first half, rather in the second half of 23, they pay out 10%, and they also pay out another bonus issue. So altogether, it's about 53% of DI. But we took a 25% payout ratio because we kind of amalgamated it, and yeah, we estimated that just a forecast that they'll pay 25%. Yeah, next slide, please. Yeah, so the next two slides are Sasseur REIT is Miao slides, but she's on leave, so I'll help to speak on her behalf. So for FY23 results, yeah, next slide, please, is mainly in line with the estimates. Yep, but the DPU, it actually fell year on year because of higher finance costs and as well as the depreciation in the RMB. So if we strip out the depreciation in RMB, the DPU would have increased 4.1%. Yeah, so on the revenue wise, it was up mainly because of better performance in the portfolio from higher variable and fixed component rents. Yeah, so for the positives, the FY23, the outlet sales was up 31%. So tenant sales, it surged 84.6% in the fourth quarter. And the Chongqing outlet continues to lead the recovery, so it's up 36% overall. So right now, the tenant sales level is about 96.6% of pre-COVID levels. And we are expecting a stronger FY24 performance. So we expect sales to grow in the low teens in FY24 because of the higher base as well. So we don't think it will grow by 30%, but slow down to about the teen level. Next is their portfolio occupancy now is at 97.6%, so it grew 0.4% year on year. So another positive is also the resilient balance sheet. So right now, they're gearing at 25.3% is one of the lowest in the whole S-REITs market, and they have $863 million in debt headroom. And right now, they are eyeing a potential acquisition from the sponsor. So this is the sponsor SIA asset. So it's about 600 million, and it has a stable cap rate of about 7%. And based on our assumptions, when it's acquired, it will generate a positive carry of about 1.5%, and it could raise DPU by about 4%. So overall, that could imply about a 45% increase in EMA rental income. Yeah, so the negatives, like I mentioned earlier, that is the depreciation of the RMB. So the RMB weakened 7% year on year, and it may continue to pose headwinds to DPU going forward, as the Sing dollar remains strong against the RMB. Yeah, so for the outlook, we expect a tenant sales momentum will continue to 24 in FY24, but it's partially offset by the stronger Sing dollar. And right now, Sasseur is paying a 93% payout ratio. They're basically keeping 5 to 6 because they have a 5 to 6 million upfront fee associated with the onshore loans. So they're keeping this 93% payout ratio to kind of account for that. Yep. With that, we maintain our target price for Sasseur. Or rather, we maintain our buy call, but lower target price to 87 cents. Yeah, so right now the forward dividend yield for Sasseur REIT is 9%. Yeah, next slide, please. Yeah, so next is Elite Commercial REIT. Basically, the title de-risk with stable cash flow till FY28. So that is after the preferential offering where they use the proceeds to pay off some of the debt. Yeah, next slide, please. Yeah, so revenue was within expectations and increased 1.5%, mainly due to the escalation. So the rental escalation is every 5 years. So it came in last year. But this is the revenue slightly offset by assets, 8 assets vacated in April 2023. So the MPI estimates surpassed our expectations, mainly because of this 8 million in dilapidation settlement with respect to the vacated assets. Yeah, so for the positives, the risk after preferential offering. So basically, they did a preferential offering in December last year. So with the proceeds they're using to pay off gearing, and as a result, gearing slipped to 40.9%. So this will result in a pro forma interest cost savings of about 1.1 pounds in FY24. Yep. So the next is interest rate trajectory is expected to reverse, so expected to come down the interest rates, especially since UK inflation remains stable in January 24, contrary to expectations of the increase. So Elite, they are anticipating a rate cut, perhaps second quarter or third quarter this year. And another positive is that they have a potential redevelopment plan where they've identified a few redevelopment assets for redevelopment to convert the vacant asset properties, vacant office assets to higher yielding assets such as like the student accommodation or data centers. So the asset value could, because of this change in use, could increase by about 20% upon completion. Yeah, so for the negatives, there's some downtime, mainly due to the vacant assets. So in the full year 23, there were 12 vacant assets. So 5 of them were divested at prices above book value. Then there's still remaining 4 assets are likely to be filled. Of the remaining 4 assets are likely to be filled by FY24. And yeah, there's some downtime for the other assets, which will be needed for reletting. Yeah, and next, the payout ratio, they dropped the payout ratio to 90%. So they indicated that they are taking a dynamic approach to this, so they might restore the payout ratio to 100% once things stabilize and the economic conditions become better. Yeah, so in our projections, we anticipate this to happen in 2025. Yeah, so for the outlook, the interest rate cuts could pave a way for asset monetization, and there's stable cash flow until 2028, mainly because of the way the leases are structured, and the stability is boosted by the absence of any remaining break clauses, which was previously allowed for early termination and rental reductions. Yeah, so as a result of all this, we lower our TP to 34 pounds, or rather 34 cents, pence. Yeah, and is paying a FY24 forward dividend yield of about 15%. Yep. Yeah, so that's assuming a payout ratio of 100%. Yeah, so that's all from me. I'll hand over time now to Peggy. Thanks. Or Zane.
Yeah, thanks, Darren. I'll move on to the technicals. Next slide, please. So for the S&P 500 last week, we saw a new all-time high closing on Friday. Currently, it's above the main uptrend channel after there was a gap up on Thursday, which saw it clear the 5,040 resistance level. So for the coming week ahead, we could see some consolidation with some resistance still above 5,100 level. Yep. So for the resistance is at 5,110 to about 5,190, or support would lie between 5,030 to about 5,070 area. Next slide. Also, we have a technical sell on Alphabet at $140.52. Take profit levels at $128.50 as well as $121.50. with a stop loss at $146.50. The stock last closed at $143.96 on Friday. So in terms of the chart for Alphabet, recently there was a breakdown of this rising wedge pattern, and looks like there's a bearish reversal pattern taking place. So after the results, it retested the $140 $140 level, forming a lower low, and then following a rebound, a lower high was created in the process, just below $150, and subsequently the stock continued to pull back afterwards. So we can see the trend actually changed from a bullish one from November to January towards a more bearish one recently. So in terms of there's also decreasing momentum on both MACD and RSI. So the stock could pull back further in the midterm towards these two take profit levels. Next slide. Yeah, so then we also have a technical buy on Tesla. So for Tesla, looks like the stock started to stabilize after the earnings gap down. Recently he has found support at the $194 neckline resistance, which the stock has broken out from following a double bottom formation. And this was coupled with increasing momentum seen on both MACD and RSI. So should the stock maintain this and rebound, it could head towards $217 first as a take profit level 1, which was a previous swing high back in end January this year. And subsequently, it could go towards $231, which was a previous range breakdown level, which was a key horizontal range breakdown level back in November to December of last year. Yeah. Next slide. So this is just a summary of the trades indicated. Currently, both are down over 2%. Yeah. So that's all from me. I'll pass on the time to Peggy to talk about SembCorp. Yeah. Thanks.
Thank you, Zane. Good morning. SembCorp had their results last week. Let me go through the details. Next slide, please. Thanks. Thank you. Thanks. Okay, SembCorp numbers came in just about 6% higher than our estimates. We are maintaining our accumulate call with our target price unchanged at $6. Just a recap of the results. The conventional energy represented by gas and related services, this segment is continuing to hold up the profit for the group. That's about 80% of their net profit for the year. This segment had a good first half last year due to a spike in the energy price in May and June. But second half, the EMA introduced the temporary price control measures. So the higher spark spread normalized in the second half. But still, this is the biggest segment of the group, which is will provide a stable and visible income for the SCI for next few years, as they had already locked in 99% of the capacity, and which is signed with the customers for an average tenure of about 12 years. So, and on a predetermined dollar margin. So therefore, this is very stable earnings. The new capacity for them will come on stream only in early 2026 with another 600 megawatt of capacity for the hydrogen-ready plant. The next segment, renewables, is the one that's growing fastest at 42% growth in FY23. This is mainly because of the increased capacity as they ramp up the acquisition, as well as they build up more capacity with their partners in China, India, and Southeast Asia. The power plants are mostly, the plants are solar and wind are mostly in the onshore, so not subject to those risks that we see for the offshore sector. And in these countries, the power is sold to the grid, and the billing is on a very timely basis. So therefore, they are not exposed to merchant risk, and the collections is very secure. Another positive for the results is that they, if you recall, they sold the India power plants, the coal power plants to to some private equity funds in late 2022. In exchange, they get a deferred payment notes of about 2.1 billion. And out of these notes, they have received 355 million in the FY23, of which 133 million represents interest and the rest are principal repayment. If not for the weak rupee, which knocked off like 46 million from this, they would have gained another 46 million from these deferred payment notes. So the cash receipt is a welcome. I mean, it's a very happy outcome for deferred payment notes. And if the amount that they receive is going to be about this level for the next few years, these notes could be repaid in less than 10 years, maybe 8-9 years. On the negative front, the integrated urban solutions continue to see weak sales for commercial and residential land and units. The industrial is the only bright spot for the land sales in Indonesia and Vietnam, as manufacturers continue to build their supply chain in these countries. Another negative is a net debt that has risen to 6.5 billion, net gearing at 1.33 times. But because EBITDA over interest has actually improved from 4.4 times, now it's down to 4.2 times. We think the risk of equity fundraising is very, very low. Thank you. Next slide, please. So we introduce our FY25 earnings estimates. We're keeping our 24 numbers. The market reacted negatively to the results because at the briefing they highlighted to us that they will shut down the power plants in Singapore for 60-day major maintenance. This is a regular major maintenance. Every power plant have to do this once in every 4 years. Usually it takes about 1 month to about 45 days. So I think 60 days guidance from SIA is a bit more conservative. We calculated this might impact their net earnings by about 66 million in FY24. This is assuming that this is a loss of profit from the power sale. During this period, they still have to honor the contracts with the customers, so they will buy power from other power plants and sell it to the customers. We assume that in this process and trading, they do not incur any trading loss here. Okay. At the same time, in FY24, they also lose about 10 million contributions from the end of term of the Vietnam power plant. This is a BOT project, so at the end of the term, they will have to hand it over to the government. So there will be a permanent 10 million loss in net profit contribution. And we also expect the property market to remain muted in Vietnam. But according to management, there's no risk of any need for write-down in asset value. So we're maintaining our FY24 net profit estimates. Energy sales and infrastructures, you see, and the breakdown here continue with the one lifting the profit. Renewable will be driving the earnings growth. And renewables share will rise to 32% in FY25. So maintaining our target price and based on 11 times FY24 EV/EBITDA. Thank you. I'll move on to SIA. Thank you. SIA had the third quarter business update. We maintain our reduced call. We raised our target price to $5.91 because we push out another year of into another year because of their year end is in March. So and then 591 is the book value we estimate by the end of March 24. So we're valuing SIA at 1 time book. The results came in, it was a negative surprise to the market. The operating profit actually fell 19%, despite being usually the best quarter of the year, where the revenue actually hit a record level of 5.1 billion on a quarterly level. The revenue was up 4.9%, held up by very strong passenger load, and cargo was also improved on 3.9% in terms of volume. But the two the yields were down. Yields is we measure it by revenue per available seat kilometer. So but even with a very high load factors, the passengers yields were down 6.6%. Cargo was down 37.4%. If these yields are still about 20% for passenger, the yields is still 20% higher than pre-COVID. For cargo is still 32% higher. So going forward in the next few, we will see load factors declining, falling below near, because they exceed the record quarter. The use passengers use especially has a likelihood of falling at a faster rate. Okay, I think the big surprise is that cost escalated by 9.3%, even though jet fuel prices were down 6.6% year on year during that period. The higher cost is also a result of a bigger capacity, and also some of the passenger costs, the ground handling staff costs have also risen much faster. And management guided that the costs will continue to rise because some of the ground handling contracts will be renewed, will be progressively renewed at higher prices. So at the operating level, Scoots had a bigger decline in operating profit, 70.5% year-on-year decline, which is quite sharp, considering that Scoot is the one that has been the one building up the traffic much faster with a higher load factors. The full service carrier, the profit fell 9.4%. Yeah, operating profit fell 9.4%. The net profit level was lifted up by several one-off. First is the higher interest income. Then they also have tax losses which they are able to carry forward to offset. So the tax-wise was very much lower. And net debt is now risen to 3.2 billion, which is in line with our forecast after they had a partial redemption of the MCB. Okay. Next slide, please. Thanks. So the airfares are normalizing, so which means that the expect yields will be coming off, and because load factors are receding, so the pressures on yields will be much sharper from now onwards. The costs are expected to rise further with more flights restoration and other airlines coming back, putting back capacity. So they're taking on more slots, demanding more ground handling capacity, and the cost at that level for those auxiliary services will go up. So we maintain our reduced call, raise our target price to 591, still priced at one time, FY25 March price to book. As we roll over to a new year, we raise our net profit for 24 by 10.5%, mainly due to the one-offs that will happen in the quarter, and also the passenger loads are coming in above our earlier assumptions. Thank you. That's all for me. I move on. I pass on to Paul for the.
Yeah, thanks. Yeah, sorry, I was still in the Raffles Medical call. Yeah, okay, so for Singtel gave a third quarter update. It's not a result, so there's no analyst briefing, but as the title suggests, the results was actually badly impacted by currency. So in terms of the results, it was within expectations, but the positive was Australia. So Australia has been, or Optus has been an issue for, I mean, the last almost three to 4 years because of the weak financials and earnings. Beginning to see some improvement. If you look on the left here, you can see the revenue is down 5%, but actually EBITDA was kind of stable, 2%, but local currency is actually up slightly. What we do see is that we see an early mobile price repair, basically price recovery, they like to say repair in Australia. And the postpaid ARPU is actually the highest in 4 years. So we're beginning to see the low-end prices, someone like TPG, which also has also competing in Australia, starting to raise prices too, because of costs and so forth. The negative was Airtel Africa. So you look at Bati. So Airtel is the African operations under Bati. So that is down 23%. Although India is doing very well, prices continue to rise, the mobile price. But they were hit by, of course, the 4% decline in rupee against Sing dollar. And there was also a translation loss in the Nigerian naira. So the Nigerian currency, totally collapsed the last 2 quarters. And that's the result. They have to recognize translation loss, and that affected the Bati results. So in terms of the outlook, so in terms of why we still like the share price. So firstly, is that if you recall in the last briefing, they mentioned they're going to do 600 million of cost out. That means they're going to cut cost by 600 million over 3 years. Even this year, they're going to continue to cut cost by 200 million. Which is going to be a surprise because they still have only 1 quarter left. But they actually said that the Singtel still commit that they're going to take out 200 million of cost this year. So there could be upside surprise. So this cost were mainly from Singapore and Australia. So just to take a step back, for Singtel, the revenue is mainly Singapore and Australia. The associates that you see here, the regional associates, PAT. So this is where all the Indonesia, Thailand, and India comes from, in case anyone's not familiar. So that's the first catalyst. The second catalyst is, of course, mobile prices. We think continues to recover in Indonesia, Thailand, and also India. And the third one is they announced plans to monetize assets. So they sold some of the data centers, some of the stake in the data centers to KKR and so forth. The next one is, of course, the redevelopment of Comcentre. So these are the things that they're going to do, and they will just pay out special dividends with it. So that's the third catalyst. We cut our numbers a little bit because we actually overestimated in finance expense. But we offset that with a weaker performance in India. So we maintain the buy, the target price is unchanged. Next slide. Okay, next slide. Yeah. Okay, so next one is HRNet, expecting growth to creep up. Now, next slide. So the results was marginally just below expectations, I think, because we do adjusted PATMI. For those who do not know, okay, so let me just take a step back again. So HRnetGroup have 2 business. They do professional recruitment. So professional recruitment is, you think, the usual headhunting for managerial and executive positions. Then flexible staffing is where you actually, the temporary workers are flexible workers. Then you can see maybe the promoters in the shopping malls, or even the back office staff in the finance industry, or even healthcare staff that are the temporary healthcare staff, like during vaccination and so forth. The one difference for flexible staffing is that they actually take on the pay. So you need a big balance sheet for this. So when you see this 250 million revenue, you see here, they actually pay the staff first, then they collect it back from the customer. So for the positive, so flexible staffing was the key performer. It continues to be a very stable business. Around 90% of this business actually comes from Singapore. And because these days, corporate customers, because of the weak macro or the uncertain macro environment, a lot of companies want to have that flexibility to, lack a better word, hire and fire. So instead of that, they actually use flexible staffing. So that's why this is like a structural growth story, or very stable. So that continues to do well, or at least stable. The margins was a bit down because the margins was very strong during the pandemic, when because of the pandemic, the urgent need for staff. During that time, vaccination, they could earn more margins and so forth. So right now, the negative is professional recruitment. So that is weak in their operations in Singapore, China, Taiwan, and so forth, because of the poor macro environment. So in terms of our outlook, so to give you a bit of backdrop, they did very well in professional recruitment during the startup times. So when legacy-wise, when there were a lot of startups in Singapore, or even in the region, their business was very strong for professional recruitment. Then when the semiconductor picked up in 2002, they also performed very well. So these have been the growth areas. But right now, actually, startups are winding down very sharply. So, and a lot of the startups, HR, the staff that has been, I guess, let go, also not looking to change because they can't get the kind of pay that they have. I guess when you're losing money, it's easier to pay people higher. Okay, but anyway, so now the growth trajectory for them is they're trying to catch a larger share of the customer budget. So because they have regional offices around, so now they're trying to penetrate deeper and capture market share because they got a wider footprint and they got more services. We lower our earnings by 11%. We still maintain a buy, mainly because we still like the whole model. They 50% of the market cap is in cash. And although HR is quite an easy thing to start up, but there's a huge barrier to scale when you want to do this business. It's easy to have a 1 to 2 man shop, but you want to have more than 500 recruiters across 17 cities. So that's where the strength is. But just that the growth will be a bit muted because the macro environment is just very tough right now because they also have operations in China. The next slide. Okay, so venture, we think the recovery is backloaded. Next slide. So for venture, the results were within expectations. The big positive is they now have accumulated almost 1 billion, a record high of 1 billion of cash. They didn't pay it in dividends, so the dividends was maintained full year 75 cents. The negative, you look at on the left here, is basically the revenue is down 30%, and it's almost like 4 quarters of contraction. And the net profit for FY23 is actually at the 7-year low for venture. And if you look at the earnings again, second half, the earnings was down 33%. So in terms of the outlook, they give venture always give very cryptic outlook statements, even when at the analyst briefing. So what they said was that the second half is going to be stronger than the first half, which is usually obvious because Christmas is obviously stronger than the strongest period for any electronics company. So what we think it implies is that the revenue softness is going to persist in the first half before we see a recovery in the later part of the year. So again, all these are crypto messages. This is how we interpret it. So everyone will have their own interpretation. What will drive growth? So some of the sectors or products that they mentioned that will be growth will be semiconductor equipment, because more semiconductor companies are shifting their supply chain from China to Southeast Asia. But it might take a bit of time now because you can't just shut down in China and bring it over here. There's also a lot of headcount you have to take care in China. So that's one of the things that might delay the process. Data center connections, so it could be more things like fiber connections into data centers. I don't think it's GPUs, otherwise they would have mentioned it, but it's more when you want to connect to any data center, you still need semiconductors to connect to all the fiber and all the connectivity within the data centers. And then they mentioned medical and luxury consumer products. We nudge our numbers a bit higher, but we still maintain a neutral because we think near term is still going to be weak based on their outlook statement. Next slide. Okay, we'll move on to the weekly. This will be my last part. So usually there's something macro in Singapore, really hardly anything, only the CPI. So I didn't really wanted to go since it's not really material. But for the US, some of the macro things was the Fed minutes. I think you can read most of it, but the key thing here is that they said that, of course, interest rates is likely at the peak, but they have not gained confidence to cut rate yet. And you just have to rely on the data. So after saying so much, they're still just back to the same old thing of relying on data. So there's also comments by Federal Chair John Williams. So this is the second most important. He's the vice chairman to the Federal Reserve. So he also agrees it's appropriate to kind of cut rates, but he thinks is that it's going to be likely the later part of this year. But of course, everyone still says back to data and so forth. So, but right now, excluding any new data points that we get, it's still going to be probably second half earliest for any rate cuts. Next slide. So in terms of our tactical views, we normally have a weekly strategy. We will put it in our morning note or we put it in our P3 community. So our comments here is that we worry right now, at least in Singapore, there are going to be risks of more value traps in Singapore. So why we say that is that if you look at NVIDIA, so NVIDIA one day the market cap rose to a record almost 300 billion. It's 276. And that one day, one stock alone is almost 70% of this whole Singapore market. The value traded for NVIDIA that day on the 22nd was 60 billion. Singapore was only 1 billion. So this value trap risk comes about because all the liquidity these days is flowing to US equity, which is obvious and needless to say. And the second reason is that with all these passive funds, which are designed to invest in larger and I guess inherently, the more overvalued you are, the larger you are, more liquidity will go to you. So that means Singapore will become even face the risk of valuations coming to derate more and more. And we see it even when we do our reports. We keep on having to cut our valuations, target price, the PE, and so forth. So as a result, what it also means is that corporates in Singapore, the return we get need to come from the corporates themselves, highlighted before. So that's why it's more and more important that the corporates that you buy need to have dividends and share buybacks, because the market is getting more and more turning to like a value trap. Yeah, especially for the small ones. Because no one's going, doesn't mean, like I said, below book value, someone wants to buy you at book value. Because there's not much, because the interest will continue to wane if all the liquidity spills over. Okay, anyway, enough of that gospel thing. The other thing we did was we actually met some property developers that are listed here, and the China property market is actually worse than expected. So just to give you some stats, so this company recently did a launch and only 13% sold out. And you know, when you do a launch, if you can, you sell out the whole thing, but you try to launch a small part, and even that only 13% sold. If you take the whole project, it's only 6% sold. So they're going to be stuck with a lot of inventory. One of the reasons is that they say that households in China are not buying because there's a huge deleveraging process coming on. So a lot of households, rather than buy, they're just trying to pay off their loans. It's almost like what's happening in the US during the great financial crisis. And if you think new launch, the property price is weak, he said that the secondary market, the decline is even more drastic. What's happening is also government finances are going to be very bad because land sales is down. And even though supply is constrained, but they think that the inventory is still probably 2.5 to 3 years of supply. So, and they really don't see where the upturn is. Basically, they're not going to cut their prices because they said even if you cut price, doesn't mean the demand will come in. So, okay, it's pretty bleak anyway, as bleak as it can get. So these are some of the key things. We have OCBC coming up and CDL, and the key macro news will be on the 29th. Will be the key inflation data coming out, but we don't expect any strong numbers because any major decline, because you saw the PPI and CPI already showed that it might be higher than expected, but the declining trend is still intact. We have, I think, 2 events or 3 events this week, Elite Commercial, Audience, and LMS. So feel free to attend. There's also Takraw, but it's not in poems yet. Next slide. So this is just my last slide. I attended the analyst briefing for Wilmar. So Wilmar, for those who may not know, they're involved in palm oil and sugar plantations and also processing. So you can be after you plant, you still need to process them to refine palm oil and so forth. And they also do soy crushing. So they will import soybean from China, crush it into meal, and then sell it to all the hog farmers. They also have consumer packs. That means they sell cooking oil in China. So in terms of the earnings was better than expected. If you look on the table on the left, most of it came from sugar actually. So because sugar prices really spiked up. But problem now is the sugar prices have corrected. But at least in the second half, most of the earnings you can see here, this is PBT on the left. You can see that it jumped more than 100%. It's almost like up almost more than 4 times. Mainly because sugar prices up and it benefited their plantations. And of course, there was also a disposal gain that kind of beefed up the numbers. In terms of what they see as outlook, it's still going to be tough. So they see processing, palm is tough because stocks are low and then demand is weak. So what it means is that when stocks low means there's not enough volume for you to process, and it's going to affect your margins. Because when you own a processing plant, most of it is fixed cost, so you need high volumes. Soybean crushing is still negative. Slightly better, but it's still quite weak. Because hog prices are weak, and then you cannot charge the customers more, cannot charge the hog farmers more. Plantations is also going to move sideways because palm oil price is at a premium to soy. So when that happens, there will be more substitution to cheaper soy and sunflower alternative. The good thing for palm oil is that cost is low, so because fertilizer is down. So the third point, the point on Central Kitchen. So Wilmar is always very aggressive on capex. They usually can spend almost 2 billion in capex, but probably this is the first time they mentioned that they are going to control a bit more on the capex, because I think the China situation is tough. They wanted to roll this major central kitchen initiative. That means one central kitchen, almost 100 million, but there's a bit of delay because customers are hesitant to move to a central kitchen because of the uncertainty. So in terms of the long-term objective, so what's the big game plan thematically that Wilmar has? So what they see is that they want to ride on the rising, the typo here, they want to ride on the rising demand for quality and quantity of food in emerging countries such as India and China. So for them, when they entered China many years ago, they from then they've seen the demand probably I don't know how many times higher for food and better quality food. So that remains their main thematic that they're riding on to supply higher quantity and higher quality food to consumers in India and China. Their guidance, again, I mean, I don't have to tell you this mentioned, but they guided that it's going to be tough operating conditions. This is as per their outlook statement. Okay, I think that's it for me. I think we can move on to
Thanks, Paul. Maybe I'll take some questions. Quite a number of questions here on NVIDIA. First question here is, hi, Jonathan. Do you think China companies will pick Huawei chips over NVIDIA? Will this be a key negative? So I guess if they could, they would. I think because when you look at the chips nowadays or the US export restrictions, which is quite significant, if there was a comparable Huawei chip to the NVIDIA's H100, for example, I'm sure they would do it. Obviously they are lagging, in that respect. So for right now, it's still going to be a headwind. The chip export restrictions are still going to be a headwind. And moving forward, I think more and more Chinese companies will gravitate towards companies like Huawei and other Chinese chip makers if they can produce chips that are on par or similar to NVIDIA's chips. There's another one here on NVIDIA. Sorry, let me find it. Yeah, so another one here is how long do you think NVIDIA's massive growth can sustain before it normalizes? Do they have recurring incomes, or are they mostly profiting from an initial boom? And then a follow-up question, how much are margins for competitors like AMD? Yeah, so first of all, obviously right now is the big boom, right? So they're benefiting from most of the hardware, but they also do have a software like a software business, software subscription business where they charge $4,500 per GPU per year, which is quite low in cost for consumers, for companies. So essentially, what is expected to, and right now this software business has about a $1 billion annual run rate. So essentially, if you think about it, as more and more GPUs are being produced and then they charge, if they maintain their pricing, naturally this business will grow. The big driver for this business is right now what we're seeing, or what we've seen, is a lot of big companies, they have a lot of large orders and they have a lot of large software teams which can talk directly to NVIDIA software teams. But for a lot of the newer entrants that are maybe not as large, they don't have the capacity to develop their own software teams, and maybe they need to rely on the expertise from NVIDIA, and so NVIDIA will do all the optimization of the software stack and all that for these kind of companies. So there is sort of a demand there moving forward. Obviously, this won't be a major part of their business as of yet, but maybe if you look at 3 to 5 years, it could be a significant portion, maybe 20 to 30% of their overall revenue. The question about sustaining growth, whether how long will they be able to do this? Actually, you'll probably start to see quite a big slowdown towards the second half of this year. I think mainly because the comps will be very difficult. I mean, you think about it, in the third quarter or fourth quarter of this coming year, when they have to compare back to the 20 billion or the 18 billion that they generated last year, you definitely won't see it 3x because it's heavily supply constrained. And so from that standpoint, because it's so supply constrained, you'll start to see the slowdown in numbers quite significantly this year. But that being said, because demand is so strong, you would, instead of 200-300% growth, you probably see something closer to, I think, in the high 80s, 90%, which is almost a doubling, which is quite significant still. You expect them to remain, maybe 80% for this year, maybe come down a little bit, 50% for next year, but still to maintain quite significant growth, at least over the next 3 to 5 years. I think that's quite expected, given the increasing demand that's popping up everywhere. In terms of margins for NVIDIA right now, they have, like I mentioned, about 70+% margin. If you look at their nearest competitor, which is AMD, AMD's margins are about 50%, just under. A big reason is because their data center business is not as large compared to the overall business as NVIDIA. So NVIDIA is about 80+% of total revenue. For AMD, it's only about 25 to 30%. So it's significantly smaller, although this number is expected to grow. But because a big part of their business is also CPUs and just your gaming GPUs, right? So that has historically been what they've been focusing on. So just based on that kind of product structure, margins are a little bit lower as of now. If you look at pricing wise, NVIDIA's new H100, or rather, I guess now not so new, H100, is going for about $30,000 per GPU. AMD's is about 20,000 per GPU and has a margin of about 60%. So for AMD, the margins are a bit lower for their high spec AI product, and the price is also a little bit. Yeah, just some comparison. Sorry, there is also another question on, I believe it's on Uber. Yeah, so there's a question here on Uber. Sorry, just now. Why is Uber going up compared to Grab? So there are several reasons for this. Firstly, Uber is a much larger company. I believe they're 50 times larger in terms of revenue. I think they generated like 120 billion in revenue for 2023, whereas Grab is only like 2 plus 3 billion. So significantly larger company. At the same time, they are also profitable, and they were profitable for the whole year, for the first time last year. And it seems that they, because of the scale, because of how they monetize, they do also operate in regions that monetize a lot better than Grab, for example. If you just look at their take rates, they are easily in the 20+% range, whereas Grab's take rates are usually in the teens, mainly because they operate in Southeast Asia, which is, in terms of GDP growth and all that. GDP per capita is a little bit lower compared to other regions like Europe and the US. So that's a significant reason why Uber is doing a lot better. They are larger. Their bookings are essentially, they are growing almost at the slightly slower than Grab, but they are a much larger company. And so there's a premium placed on the company like Uber. But financially, they're doing a lot better than Grab. They don't have to spend as much money. They can get higher take rates, and they earn way more money from the top and bottom. Yeah. So hope that helps to clarify. I think I'll hand it over to the rest of my colleagues for the other questions. Thank you.
Yeah, so let me just take on because I need to leave soon. I'll just take on. Sorry to interrupt those who wanted to answer earlier. So hi Paul. On the Genting one, I think Peggy can take it, of course, but mainly because it's a provisioning. The problem is they don't invite us to their call. So is okay. So let me just say, okay, is venture a good value to buy now versus the recovery? In a way, it is. I think probably there's like a 5% or 5% plus dividend yield. But just that they disappointed so many quarters in terms of revenue. I just want to be more assured that there's a recovery coming in for them. The problem is that they don't really identify which are the sectors or product lines going to be the big recovery for them. So I think because of the dividend yield, I think there's still value there. But I rather wait until maybe after their first quarter results to get a better reflection whether is this path, because they can always just say, oh, I think the recovery would be delayed again. So that's my worry. Okay. Sorry, let me just. Hi Paul, you mentioned your strategy, Singapore stock risk remaining value traps. What are some of the telltale signs of a value trap? One telltale sign is just the valuations. So even for me, as I'm trying to put target prices for all these stocks, the valuations keep on contracting. Like a simple one is like Thai Beverage. They used to trade at 18 times because you're a consumer name. then dropped to 16 times, 13 times, now 11 times. There's no reason why these stocks can't drop to single. There's no like law, there's no physics why these stocks cannot trade to high single digit, mid single digit. Yeah, so that's the worry. So once you see valuations continue to contract, and one of the reasons is also because the growth has been weak. It also moves in line with the growth outlooks. But if the growth can rebound, then maybe the valuations can creep up. But even then, we just worry that this is the telltale signs of valuations will just keep on contracting and contracting. Okay, I will take one last one. Paul, can you give more color to Raffles Medical performance and outlook for earnings call? Okay, so we haven't issued the report, so we will just share with you what they mentioned. There's probably 3 worries that we have. Actually, nothing is going to perform well for me in my own view. Firstly, the most drastic one they mentioned was foreign patients. So Singapore always been a hub for foreign patients, but right now, virtually you're lucky if it even remains stable. These are not my words, but I think so. That's the worry now, because number one, the Sing dollar, and number two, because of the pandemic, a lot of foreign patients decided to when they did their elective surgery in their own countries, they realized that the service was just as good. Of course, not as good as Singapore, but was still manageable. And thirdly, there's competition from Malaysia and Thailand. So these are the things. And then the pandemic is going to, I think, still one more half of pandemic income, my own estimate. And then for China, and then they have also have an insurance business, which is very funny, right? But anyway, they got this big insurance company, insurance business inside Raffles Medical, and that also that swung to losses because there weren't many claims. A lot of patients didn't do elective surgery because of the pandemic. But now that they did, their losses, they started to recognize losses in the insurance business. So only China is slightly better, but it's still going to be a loss-making for the next 1-2 years. And so I don't see anything positive for Raffles Medical in the near term. Yeah. Okay. Thanks, Evan. Sorry, I have to leave. I'll hand it over to the rest. Yeah. Thanks for the questions.
Okay, thanks, Paul. Yeah. Maybe I'll just take it. I'll carry on. Okay. Quite a few questions on the banks. Okay. First one, what could cause the UOB price to keep coming down despite a good dividend? I think someone else replied on my behalf. Okay, but I'll just put it in a different way. So I mean, UOB's price, yes, they did give a good dividend. I would say if you look at you just look at UOB alone, right? They gave a pretty good dividend, right? It's up, and then it's but the dividend yield may not be as attractive. So if you compare it to the other banks, let's say OCBC and DBS. So DBS released their results before UOB. I think DBS, they gave a really even better dividend compared to UOB. So that might be one of the reasons why UOB share price went down. And I think another reason is also because DBS is very aggressive with returning it back to the shareholders. So they said, firstly, they're going to give that bonus share issue, and then they're going to keep up with their 24 cents per year increment, which means that, if you look at this year at least, you're looking at around 7.2% dividend yield. And if you go into 2025, which is where they said their 24 cents will continue, it might be even higher, right? Depending, of course, on the share price. Whereas UOB is maybe more prudent on that side, and they're just saying that, okay, we're going to maintain our dividend payout ratio at 50%. So we're not going to change that payout ratio. They're not going to increase it, but they do expect that their earnings or their PATMI will increase. So if you look at the core dividends, the amount itself, if their earnings do go up and they maintain a 50% dividend payout ratio, we should see an increase in dividends. So I think, even if that included, we're looking at only around maybe 6.7% dividend yield. So compared to DBS, who has already, put everything out there and said that, okay, we're going to give you this is around 7.2%. It is better, which is why I guess people, have gone maybe to DBS instead, and hence why the share price has gone down. Yeah, so this person also helped to reply in a different way, but come to the same answer basically. Let me move on. Okay, there's quite a few. One more. Hi Glenn, after UOB's debacle last week, what goodies or lack of are you expecting from OCBC this week? Okay, so if you look at OCBC, they are really in between. So DBS is very open and aggressive. They will tell you upfront what they're going to give, how much they're going to give, and when they're going to give it, right? Whereas UOB, on the other hand, they are a bit more prudent. They're just looking at their earnings, say, okay, we'll give you back 50%, and that's it. Don't expect anything more. That is it, 50%. So whereas OCBC is, I would say, they're not so open, but yet they don't say anything. Yeah, so basically they don't say anything. They don't tell you, okay, we're going to keep at 50%. So during the last results earning, I think there are quite a few questions the analysts we all asked, and then they were like, oh yeah, 50% is the minimum, right? If there so we asked, is there a chance to increase? They said, yeah, possible, so it doesn't really say anything, doesn't really tell us anything. But when they do say that, means that there is definitely a possibility for them to further increase the dividends. And we look at, like, I did I mean, last week, I think if you were listening, I did this sort of a comparison between the bank's dividend yields. So for OCBC, which was the highest dividend yield before DBS came out with their really bonus issue and the high dividends, they were the highest at around 6.5%, 6.6%, I think. And for them to reach the same level as UOB, they will only need to increase their full year dividends by 38%. And this will represent roughly 60% dividend payout ratio for OCBC. So it's not far off, and it could happen because they do need to return capital. Both DBS and UOB have been spending their capital, maybe not really by returning it to shareholders, but by doing acquisitions. Both their city acquisitions were quite costly to them. But OCBC, I mean, they haven't really done many acquisitions. The only one that they have done in the past, in the recent history at least, was that Indo asset which they acquired is less than 200 million. So it's really didn't even put a dent to their capital, their CET1 ratio. So hopefully we could see them returning this excess capital which they have. And I think they still have the highest CET1 ratio. Okay, one about iFast. iFast back to being a growth stock after last week's results. Why market punished the share price? So I didn't manage to attend the presentation because they held it at the same time as UOB. So I think for iFast, I think the main highlights were that their revenue, their profit went up like 900%. I think that was the main highlights you see in the news. So I think but then again, it is quite expected, because their Hong Kong e-pension business did kick in, right? So, but I think what we could see from their results is that their banking operation, which is their iFast Global Bank, did reduce their losses, right? So that was one of the plus points. But I think why the market did punish the share price was because their guidance, going forward for the Hong Kong e-pension, while they have kept their earning guidance for the Hong Kong side, but they did lower their revenue and I think their profit margin as well. So that might be one of the reasons. Yeah, but I'll try to watch. They haven't uploaded their presentation yet. So when I watch it, then I can give you more details on this. Okay, I think I have quite a few. Okay, one more. Seems like bank allowances are going up across the board now. DBS and UOB. Yeah, this is quite expected because we are returning to a more normalized state. But if you look at what was happening before COVID, right? So COVID, of course, there was a huge spike in allowances and credit costs. But if you look before that, it stabilized around 20-25 basis points, sort of. So what we're looking at was, because there was such a huge dip where they did so many write-backs in 2022, right? Post-COVID, right after post-COVID, because they accumulated so much allowances and provisions, so they had to write it back, which is why we see this allowances going up across the board for the banks. I think OCBC will be quite similar as well. So I don't think it's really going up per se, but it's more of a normalization of these allowances. Yeah, and I think they have also similarly guided for their credit costs to be a pretty normalized level, 20-25 basis points. Okay, there's this one question here. Bonus issue versus cash dividend, which is better for existing investors? I think it's not, maybe it's for Darren and myself, but looking at DBS, they did give their bonus issue, so share issue. I think it really depends on the individual investor, what you're looking for. But the reason why they gave the bonus issue is more because this is something that they cannot take away. So once they give this bonus share issue, the investor will have it for as long as they want to hold on to it for, basically. But where they give cash dividends, or they increase or give a special dividend, let's say, this can be taken away, or even an increase in dividends. So if they increase it by 50%, but if next year they don't do as well, right, they can always lower it back down to by 50%, right? So that's the reason why DBS decided to give this sort of bonus share issue. And I think for investors, it really depends. If it's for a longer term, then the bonus issue will be better, because you're looking at something that you can hold on to instead of just cash, right, where they give it to you and they can take it back. Yeah. Okay, I think still have quite maybe one or two more questions for me. Just let me run through. Maybe. Okay, one more about the iFast. What price should I buy iFast? Okay, sorry, we don't cover iFast, so I really can't tell you what price to buy at or what is the target price. Maybe Zane can do a TA on iFast later. Yeah, thanks. Okay, I'll hand you over to the rest of my colleagues. I think that's all for the banks.
I'll take the question on Mercado Libre, comment on the result. So they just announced their result for the fourth quarter. Their revenue was in line with the forecast, with 42% year-on-year growth. This is actually the fastest pace of growth since 2022, the third quarter. The reason for such a fast growth is because the company is really focusing on technology and innovation. So they managed to accelerate the rate they get unique buyers. It's accelerated the fastest rate year on year since 2020. They have almost 85 billion unique buyers every year. But the reason share price went down is because their profit actually was hurt by a few one-off tax expenses in Brazil. So they were expecting net income of around 360 million, but it turned out to be only 100 plus, 165. But the company did mention that if you take away the one-off cost, the net income was actually 383 million, which is actually better than expected. But I guess people just took it badly because it was almost like half of what was expected. So the response was not really positive. The share went down 7.9% as of now. As of the target price, we don't really cover the company, so we cannot really give you an idea. But if you like, I guess then can do TA on that. Yeah, I'll pass my time to other colleagues.
Maybe I take over. Thanks, Helena. Okay, I have quite a number of questions here. Hi, Peggy. Do you see any possibility that SETS might pay dividend this year? My forecast is SETS will pay a dividend of 1.4 cents for the year ended March 24. Yeah. So there'll be a small dividend, but the yield is very, very low. Very, very small. We think the full year they will make a profit of about 71 million Singapore dollars. Thank you. Next question. I think Paul highlighted something about Genting just now, and he asked me to elaborate. Okay, the question is, hi Paul, Genting missing results by a small percentage, but with better revenue, yet the price has been on downside. Any comments? Genting, mainly because the fourth quarter numbers were really bad. It's down 1.7% year on year. This is in sharp contrast to the strong 9-month 23 performance. In first 9 months, they actually the net profit grew by 2.24 times. So in the fourth quarter, what happened was it provided 140 million, 140 million for impairment on trade receivables. That means somebody is not paying up. Okay, this is like 4.5 times higher year on year. Usually they will also blame it on poor luck factor, which they did this time. They use this excuse. Usually we feel that it used to just smooth out the earnings, but impairment for trade receivables sounds fairly serious here. It means somebody just not paying up. So therefore the market is not very happy with their set of results. Yeah, thanks. The next question. Hi Peggy, can SIA stabilize knowing first Q with China opening, etc.? Okay. During the results call, we spoke with the CFO. They say they have not seen any abnormal behavior in terms of load factors. Whether even with the China 30-day visa-free travel, or even with Taylor Swift coming next week for her concert, for 6-day concert. So there might be higher traffic numbers, but it probably will be across the board for all other flights, for other airlines as well. So the not specifically will definitely benefit SIA per se. Even then, most of these travelers will probably be on the low-cost carriers route, because these are leisure travelers, and the third quarter numbers show us that this Scoot is actually operating very, very near to its break-even load factor already. So if the cost were to increase any further, Scoot would actually might incur an operating loss for the following quarter. Yeah, thanks. I'm trying to, okay. Next question for me. Please assess on C-Stream results announcement and share consolidation. Thanks. Okay, just came off from the conference call with them after the results were announced this morning. Let me go through. Let me just flip through to my spreadsheet. Okay. I dig first for the positive in the results. Okay. Since it's a Monday, let's look for something positive first. Okay. The thing is, they managed to move their short-term debts to long-term. They managed to refinance all the debts. So therefore, they're no longer if you recall in the first half results, I mentioned that there's a 2 billion short-term debt that they need to quickly think of ways to refinance. They managed to move this to the long term. So they in terms of the net current assets, they are in a more comfortable position. That's one. The book NTA and book NAV at the end of December was 9.5 cents. Okay. So the market is trading at near to this level right now, but NTA is 3.3 cents. So between these two numbers, it's a goodwill which they recorded after they bought over Keppel O&M, and very little of write down in the goodwill. That we felt is a bit of risk there, where potentially that could be future provisions. Then let's go to the not so happy part of the results, right? The order book ends at 16.2 billion at the net level. They said they secured 4.5 billion order book. That's gross. So at the net level, it's about 2.7 order book secure. And most of these orders were secured in the first half of last year. So for the whole of second half, I think that nothing much was, no new orders were gathered. So for end of first half, the order books was 19.7, drops to 16.2 in second half. So the order momentum has actually slowed down. We see this also in the Dynamic actually. Yeah, so we think across the board, the oil and gas sector, the O&M sector might see some pressure, especially with the limited credit available for fossil fuel and also for offshore wind sector. So the order book is one negative. Second thing is they make a lot of provisions this quarter, this half, which in the balance sheet is outstanding 1.46 billion provisions made. Of course, at the call, they said all these provisions that they made are non-cash. I think they missed out one word, it's called non-cash yet, because 1.46 billion, the provisions in the balance sheet will need to be paid out sometime, will need to be realized in some way in the future period. So therefore, even with the 2.27 billion cash that they are holding at the end of December, we think that might have to be set aside to meet all these provisions to be met. And during this period, they managed to have very stronger cash flow also because they squeeze their suppliers and yeah, poor suppliers. Yeah, and in the announcement they mentioned that they are going to close 1 yard in Singapore and 1 yard overseas. So there will be a capacity reduction. They also make restoration provisions for the yard in the shipyard route and Pandan route. Yeah, I'll check out the conditions in the yard this weekend maybe. But it looks like there will be a big consolidation in terms of the workforce and the amount of work to be undertaken in Singapore market, in the Singapore yards. So sorry to bore you so much details, but long story short is like they still have cleaned up a lot, but I think probably still not very enough. The order book right now of the 16.7 billion, about 80%, about 80% is related to Petrobras. It's a very high concentration on one customer. The settlement of the corruption case in Brazil is a relief. That's a positive, but Singapore side is still not over yet. Yeah, so if you look across the Singapore market, you don't need to build up your stress by buying into this company. You could do better with some other stocks in your portfolio. In a share consolidation, it will bring the NTA back up to $1.90 after you 20 shares string into one share. But besides just a mathematical consolidation, I don't see much positive impact on the operations and the balance sheet. Thank you. I hope I've answered the question. And we also asked a few times whether they would do a rights issue. No really concrete answers, yes or no. The whole briefing sounds like just an English class, learning a lot of very bombastic terms, but no real definite answers from the management on whether they will do a rights issue or any more fundraising. Thank you. I hope I've answered your question. If you have any specific areas you want me to address, please drop a further question. I'll take that. Thanks. Okay, let me go on. Okay, there's another question on C-Stream. I hope I've answered that. Yeah, I think there's a question on Singapore Airlines. SembCorp first. What causes SembCorp to drop so much? Is their net current liabilities of 770 million a concern in the balance sheet as compared to earlier years? Thanks. Okay, the SembCorp's it declined mainly because they guided a plant closure for 60 days, which we estimate will cause a 66 million impact to the net profit. I don't know why the market has not factored this in, because this maintenance is like a 4-day, once in 4 year event. So I have actually earlier built it into my forecast. So, but I think the market was surprised by it. So there was quite a bit of adjustments in terms of consensus numbers. So therefore that decline. On the SembCorp's net current liability, yes, I mean that arises because they moved the deferred payment notes receivable to non-current assets, from current assets to non-current. That's about 1.8 billion. So when they moved that up, the current assets fell by the amount, and therefore it looks like they had a net current liability. We assess the cash flow level. We don't think there's a risk here. Mainly because of the power, it accounts for 80% of their profit. Is really in Singapore, power sector is really very secure. Payment is on time. You got your bills deducted from GIRO, even you don't feel it, but it just disappears from your bank account every month. And then on their renewables business, the energies are sold onto the grid, so they don't face merchant risk, and that part of the cash flow is also very strong. So we even with a net current liabilities, we don't see a risk in terms of cash flow for SembCorp. So we don't think that's a concern. Thank you. So there's the next question. What is the potential of C-Stream issuing rights issue here? Will the share consolidation help them in any way? First is we're not sure whether there's going to be a rights issue. It looks unlikely because the share consolidation will need shareholders' approval first. So that will drag out another 60 days. So next 60 days we are quite safe. I think share consolidation will they help them in any way? I don't think so, except that to move them away from being called a penny stocks. Because their NTA will be $1.90 after you consolidate 20 shares into 1 shares. Yeah, but that's just accounting magic. Not much help to the business. I think there's a SIA. Another question for me. Hi Peggy. SCI good results, but the price keeps dropping due to net debt or other reasons. Yeah, so I explained earlier because the consensus are trimming their numbers to account for the plant shutdown for major maintenance for 2 months in the first half of 2024. Otherwise, I think no other specific reasons. Thanks. Hi Peggy, who will SCI buy power from? YTL. Yeah, SCI will have to buy from the pool. So the pool, those who will drop their spare capacity into pool will be the YTL, your Keppel, those who have spot capacity. So YTL says they still have 10% of spot capacity, so they might be the one who is selling the most to SCI. But the chance of them collecting an exceptional gain from this SCI's unfortunate situation is not so strong now that with EMA coming in with TPC, temporary price control measure. You'll be quite sure the EMA knows how to smooth out the price fluctuation. So there will not be any exceptional spike in the power price for other power generator to benefit or for SCIs to lose out in a big way. Thanks. Next question. SIA seems bad. Rising competition and cost double whammy to the income. It's part of the airline operating business. Airline is really a very lousy business to run, in my opinion, because you must have a tip-top good planes, you must have very good pilots, you must have a very good service, and yet it's very easy to add capacity and every new carriers can now come in very quickly, and they just lease planes from the leasing companies, and they can start operation of 10 to 14 aircraft straight away. So this is very poor bad business. It's worse than stockbrokers actually. Thanks. Does SIA cost pressure mean SETS also facing higher cost too? Think SETS results this week will be under pressure too. Because SIA guided that they are going to pay higher ground handling charges. So some of the analysts were actually quite upbeat about SETS, thinking that SETS might be able to revise their contract price upwards. But we think maybe not so immediate, because all these contracts are usually for 2 to 3 year time frame. So the potential positive is that the going forward, the cost is going to be higher, definitely, but not so immediate flow to the SAT's bottom line yet. At the same time, SATs is also facing higher pressure from higher costs as the airports are also going to charge higher fees, and yeah, the staff costs are rising at a faster rate too. So SAT's results are coming out this Wednesday. We think it will grow from first quarter, but still will face some will not be returning to the pre-pandemic level of 280 million for a full year that we've seen before. Very, it's a long shot from here. Thanks. Okay. Peggy, any opinion for SC Engineering, please? Any possibility on dividend increase for fourth quarter 23? Reporting is this Thursday. Yeah, this Thursday is going to be a brutal day for us. Yeah, the ST Engineering at the air show we visited. In my opinion, I think there's not many new products that they had for this year compared to last year. So that's only my visual view. Not to count on. The two positives that I came away from the air show is that the ammunition, the demand is really very strong. The most of the countries are stockpiling ammunition. I know Singapore, SC Engineering is one of the second or third largest, if not maybe the largest now in terms of this ammunition. So the stockpiling from the defense side is something that is going to be a tailwind for them. The TransCore, the other good news is that TransCore is on schedule. The installation is on schedule. That's going to start operational in the New York by June this year. So when that milestone is achieved, a lot of that payment will come through to SC Engineering. So that is the second positive. So I think going forward, the defense sector will still be the one that driving the earnings. The aerospace side is also coming out very strongly because of the engine issues with the GTF for Pratt & Whitney. And the other thing is with more low-cost carrier getting into operation and more demands from leisure travel. So there's more airlines are deploying narrow-body aircraft as against wide-body aircraft. So SC Engineering has traditionally been a narrow-body player, a narrow-body aircraft a player. So they are in a good segment, and they are where they have the hangar capacity as all benefiting from the increase in the travel. So SC Engineering in terms of MRO business and also the engines and components business is going to fare better compared to the entire industry, MRO industry. So I don't think there will be a dividend increase for fourth quarter, because the thing about SC Engineering is they follow strictly to the script. They never deviate, even though you try to. So we think there'll still be 16 cents for FY23, but going forward 24, there's likelihood of an increase as they probably want to make sure that they will be dividend stocks for the investors. Thank you. Okay, Peggy. Okay, I got it. Peggy, please give direct answer. Okay, and don't drag the answer too long. Okay, Peggy, will CAO be hosting any updates? She says on Friday. Are you still positive on CAO? Yes, I am. Yeah. investable at current price. We think you our target price is $1.01. Yeah, so we think there still be a bit of upside to the share price from here. Thanks very much. I hand over to the rest of my team. Thank you.
Yeah, thanks, Meg. Yeah, let me answer some before I hand over to Zane for PA. Just some quick ones. Any update on SembCorp REIT? Yeah, so for SembCorp REIT, the latest update is that they managed to settle the DXC dispute that was in court for about for about 2 years. So basically, what happened is they settled out of court, and DXC will be paying SembCorp REIT 13.3 million. So this is based on the amount of rent that the disputed rent. Yeah, so they settled out of court. So but in regards to the Kwangtung data center, yeah, no updates there yet. So yeah, we're waiting for more updates there. But in our view, we think it's unlikely they'll be able to get back any rental in collection from the tenants in China. So yeah, in our model and forecast, we've already accounted for that. Yeah, so yeah, no updates other than the DXC dispute that. Yeah, so that's a direct plus of 13.3 million to their income. Yeah, so that's what Prime has a huge bulk of loans due for refinancing this year. Does it mean they need to fire sale their properties to deleverage? Yeah, so basically, if they are able to refinance their loans, which management seem quite confident, and they have until July 24, then they do not have to fire sale their assets. Yeah, but if in an unfortunate situation where they might they are not able to refinance their loan, then it might be possible that they might have to do so. Yeah, so that's my comment. Just all eyes are on the refinancing of the July 2024 loan. Yeah, it's under Bank of America main credit facility. Yeah, why Prime gave distribution now even though they're not committed to future dividends? Shouldn't they already start to conserve cash? Yeah, so they say they have the shareholders in mind. That's why they are paying this 10% distribution, 10% of distributable income in second half in the second half. Yeah, so and on top of this 10%, they're also giving a 1 for 10 bonus issue. So that doesn't really affect the cash. It will just dilute the shares upcoming, and they say it's to reward shareholders, but ultimately with this bonus issue you dilute the DPU, and the share price will likely come down as well in proportion after the new shares are trading in the market. So yeah, in our view, yeah, so basically they did not commit, and in our view, going forward they also they might not be able to pay 100%. So we think for now we've put a 25% payout ratio for Prime US REIT. What does in place rents and asking rents means? So in place rents basically mean that the rents that are that are in the portfolio that the tenants are paying currently. So in place rents, passing rents is kind of the same thing, and then versus market rents, which is what tenants in the market are asking to pay. So basically for Prime US REIT's case, the current rents that they are getting, which is in place rents, is still below the asking rents by 6.5%. By asking like what the tenants are asking for in the market, basically. Keppel big name scared can't refinance. Prime so confident they can. Yeah, so yeah, Keppel Pacific they're taking a very precautious and proactive measure to keep their gearing low versus Prime. Yeah, so Keppel Pacific was really taking a conservative approach. Yeah, but in both Keppel Pacific, they're also confident that they will be able to refinance their loan that's expiring in FY24. But for Keppel Pacific, it's more towards the fourth quarter this year. What's the outlook for CLI upcoming results? Yeah, so for outlook, like based on their earnings, profit guidance, end of last year, they mentioned that because of fair value losses, they might experience quite a significant amount of net loss for FY23. But operationally wise, we don't think that they're very significantly impacted. So we still think operationally wise, like the fee income, yeah, it's still very strong. Yeah, the biggest thing is the asset devaluation that we're keeping a lookout to see how big the impact is. Yeah, and operationally wise, there's also a bit of weakness in China, so we are also keeping a lookout for that. Yeah, okay, I think I'll hand over to Zane for TA now. There's still a lot of questions. Don't think we'll be able to answer all, so I'll hand over to Zane for TA for the last 5 minutes. Thanks.
Okay, thanks, Darren. I'll do a quick one. Apologies, I can't answer all. First one will be UOB. So for UOB, yeah, share price has pulled back, but I think it could be nearing some support levels soon. We could see share price get some support around the $28 level. And this was the uptrend channel support. We also had the swing lows over here. So about 27.70 to 27 to about $28, we could see the share price start to stabilize a bit. And for DBS, yeah, DBS is currently doing a bit of a pullback. I would think that it probably would do a bit of a range consolidation afterwards. So it's currently retesting a previous strong resistance level around 33.40. So probably around 33 to about 33.40, this area price will be able to get some support. Yeah, currently it's around the 10-day, I think it's around the 10-day average as well. Yeah, about here. So the next one is OCBC. So for OCBC, price also pulled back recently. So the chart is a bit similar to DBS. Yeah, so over here, I would think that if it does a retest of the $13 to $13.10, this prior strong resistance area, we should be able to get some support for a bounce. I will lean towards more of a range consolidation. Yeah. The next one is on SCOT. Yeah, so for SCOT currently price I would think might do a bit of a range bound. It might go on to retest the 90 cents recent swing low level. A bit of bounce, but I think short term wise there's still likely some pressure from 92 cents to about the 94 cents area. Yeah, so for now it could just do a bit of retest and hold there for a while. Next one is STAC. Okay, for STAC, it looks good. Reason being the breakout of this downtrend resistance line over here and strong momentum recently. Currently, it reached an area of resistance previously around the 94.5 cents to 95 cents level. So it could do a bit of a sideways consolidation first, but the trend still looks good for now. Given this price over here. Yes. Okay, then next one is on Carvana. Okay, for Carvana, after the earnings release, there was a gap up over here. I think it's quite significant because there was a gap above the key resistance zone previous of 57 to about $62. So previously price has been couldn't cross this area for like I think 1 to 2 years, but with the results is currently above that. So if you can hold above this resistance, I would think that there could be some upside, more upside further here, given there's not much resistance in this area in the past, where the next key resistance is close to like $90 over here. Yeah, so let's see how it goes for this counter. Okay, then next one is on Amazon. Okay, for Amazon, currently is just range trading, but a strong end to the week. Thursday, Friday, there was a gap up and then we tested the highs over here at $175. So for now, it could still see a bit of range trading, but I think it's still positive. If you can hold the 170, 171 level over here, which is a 5 and 10-day moving average, we could see more upside if that's a higher low in coming days. Okay, then for Google, Google a bit more bearish. It could be this downtrend resistance line over here, and we're seeing price recently they are doing a retest of the rising wedge breakdown, And over here, there's a confluence of resistances with the moving averages as well. So I would expect price to find some resistance over here and might do a bit of a sideways for this week around the 140 to 144 area. Okay, then for Broadcom, price has been quite range bound, but on Thursday, Friday was a strong, it was strong, and if you can hold this break over 1,280 level, I think could be positive for some upside. Yeah, but for now I would lean towards a little bit more, still a bit more consolidation first for this counter, because I think it's quite a lack of momentum when I see in terms of the MACD. Yeah, when price is just quite consolidating for this current period. Okay, next one is UMS. Okay, UMS I think is still trending strong. Currently it's at the all-time highs, if I'm not wrong. So we might see a bit of a consolidation ahead. Even price is starting to smooth out a little bit. Yeah, then there's also earnings coming. So I think that would take the price more in the coming days. And Franken, also another one reporting earnings. Franken pulling back a bit from 159 resistance level previously. Currently might find support around 146, 147 if it touches the 10-day average. But currently still on a strong uptrend. We'll see how it goes after the Delphi. Delphi is another one. Only Delphi is more range bound trading. Currently still some support around the $1.02 level. It's been quite sideways. So I think for now, you're still likely to just trade in this very small range. Currently it's around $1 to about $1.06 per here. Okay, then for AEM. Okay, then for AEM, I think currently quite range is doing a bit. I think it's doing another range over here, between like 270 to about 285. So I think could just range for a while. Positive is that the short M is 5 and 10 are cross over the 20-day for now. So yeah, could see some support if it does a back test or prior resistance at 270. Okay, maybe I just answer like a bit 4 more in view of time. Sorry, I can't take all the questions. Okay, next one is city development. Okay, so for CDL, price action is still quite weak. Recently, price did a retest of 615 prior support. Still finding resistance. So over here, we still have a very strong downtrend happening. So likely price is going to retest the recent lows, which is around the 590 level. And we might still see lower lows. It continues to form a lower low. Yeah, so I think overall it's still quite weak for CDL. Then for Genting, price continue its bearish momentum today after the strong sell down in volume last Friday. So for now, I think the next support level to look out will be around the 90 cents level over here, which was swing low back in November, December of last year. And then this is just a guess, but I think we might find some support around 88 cents to 90 cents area. Because previously 88 cents was quite a strong resistance of inverse head and shoulders breakout. So yeah, price might start to stabilize a bit, but we're still going to see how it goes. The next one is Mapletree Logistics Trust. Price has been quite sideways recently, so I think for now it could trade give a range bound pattern. But if you continue to find pressure around 152 onwards with these MAs as well, still turn down a little bit, given that it's still in this downtrend over here. Okay, then last one I'll take is Escon. Okay, maybe I just comment on the STI one. Okay, for STI, so a question, is it going down to 3,100? Personally, don't think so in the very short term. What I've seen currently is that it looks like a repeat of what we saw in end December, start of January this year. So there was a price rapid rise after the Bollinger Band expansion, and we're currently seeing a sharp fall, similar to what we saw in middle of January. So afterwards, what happened was that there was quite a sideways going on. So I think we might see something similar where we might do a bit of sideways with support coming maybe 3120. Yeah, it's close to 3,100, but I think probably we might see the index consolidate at a higher level, hopefully over here. Yeah, in the coming days, weeks. Yeah, I think that's all from me. Apologies, I can't answer all in view of time. Yeah, thanks.
Sorry, we passed the 1 p.m. mark. We have to end the session here. Yeah, thanks everyone for your time. There's a comment in by Michael in the chat. We'll take note of your suggestion. We'll see what we can do about that. Yeah, thanks again, everyone. Hope you have a good week ahead. Thank you. Bye-bye.